Okay, here's a question that's on a lot of people's minds. What if a government tax could quietly reduce the money you earn from your investments without changing the stock price? In this video, we'll discover what tariffs are and why they might affect the dividends paid by certain companies. We'll break down the connection between trade policies and investor payouts, showing real-world examples that make this simple to understand. Keep watching to find out the key signs investors look for when tariffs may threaten dividend growth and how to protect your income. Alright, let's start at the beginning. What exactly is a tariff and why does it matter to investors? A tariff is a tax placed on imported goods. Governments use tariffs to make foreign products more expensive, which can encourage people to buy locally made goods. While tariffs are a tool for trade policy, they can also raise costs for companies that rely on imported materials or parts. If a company's expenses go up because of tariffs, it may have less money left over for shareholders, meaning dividends could be reduced, paused, or grow at a slower pace. Do tariffs always cut into profits? Not every time, but often. Some companies can raise prices to make up the extra cost. Others may switch suppliers or move production. But these changes take time and money. In the short term, profits often fall, especially for companies that depend on goods from other countries. Even a short drop in profits can make a company think twice about increasing or keeping the same dividend. Do tariffs always mean lower dividends? Not necessarily. Companies with strong cash reserves, low debt, or pricing power can sometimes pass tariff costs to customers without losing sales. In those cases, dividends may remain stable, but smaller companies or those in competitive markets may not have that flexibility. The result is some businesses keep paying steady dividends despite tariffs, while others see payouts drop sharply. It depends on the company's financial strength and industry conditions. Can tariffs ever lead to higher dividends? Yes, if a company benefits from tariffs. For example, a domestic producer facing less foreign competition might see sales rise and profits grow. With fewer imports undercutting their prices, they can capture more market share. In these rare cases, tariffs may boost earnings, giving companies room to increase dividends. But this usually applies to industries shielded from imports rather than those dependent on them. So, which sectors are most vulnerable? Industries that rely heavily on imports, such as electronics, automobiles, and apparel, can be hit hardest. A car manufacturer importing steel or aluminum may see costs spike quickly under tariffs. Similarly, a retailer that sells imported clothing might face higher prices from suppliers. When operating costs rise faster than sales revenue, dividend growth can slow or even reverse. Investors in these sectors often monitor tariff news very closely. How do companies respond to protect dividends during tariff periods? Some cut other expenses, streamline operations, or shift supply chains to avoid tariffed imports. Others may temporarily reduce share buybacks to free up cash for dividends. In rare cases, companies suspend dividend increases but keep paying the same amount until conditions improve. The priority for many management teams is to protect their reputation as reliable dividend payers, even if that means making sacrifices elsewhere in the business. But do all companies react to tariffs in the same way? No. Larger, established businesses often have more options, like multiple suppliers or the ability to move production. Smaller businesses may have fewer choices and take a bigger hit. The flexibility of a company's operations often decides whether dividends stay steady or take a hit. The bigger and more adaptable the company, the better the chance of protecting payouts during tariff changes. How do investors figure out if a dividend is at risk? Analysts look at payout ratios, earning trends, and sector exposure to imports. If a company's payout ratio is already high, any drop in earnings due to tariffs can trigger a dividend cut. Watching earnings calls, company guidance, and trade policy updates is key. The sooner investors spot warning signs, the more time they have to adjust their portfolio and protect income streams. What can investors do to protect themselves from tariff risk? Diversification is the simplest approach. Holding dividend-paying companies from different industries and regions reduces exposure to any single tariff policy. Choosing businesses with low debt, consistent earnings, and a history of stable dividends adds another layer of safety. Even when tariffs disrupt one part of a portfolio, other holdings can keep income steady. How does investor confidence pay into tariff and dividend changes? When tariffs are announced, investors often react quickly, sometimes selling shares before any real financial damage occurs. This can pressure companies to adjust dividends to keep shareholders invested and calm the market. Market psychology can influence dividend decisions almost as much as actual profits. Do changes in currency affect how tariffs impact dividends? Yes, it certainly does. If tariffs make a country's currency weaker, buying imports costs even more. But at the same time, selling goods overseas can become cheaper for foreign buyers, which might help some companies earn more. For dividend investors, currency changes can make the effects of tariffs bigger or smaller depending on how the company does business. So, are dividends safe in a tariff-heavy economy? The answer depends on the company's ability to adapt. Strong, diversified businesses with global operations often manage to keep dividends stable. But companies tied closely to imported goods face more risk. Investors who understand this link between tariffs and company profits can make smarter decisions, protecting both capital and income. Tariffs are more than just trade policy. They can directly impact the money investors receive in dividends. Whether the effect is negative, neutral, or even positive depends on the company's industry, financial health, and ability to adapt. In a world where trade rules can change overnight, knowing how tariffs work is essential to protecting long-term income. And now that you know the connection, you can watch policy changes with a sharper eye and keep your dividends working for you.